Why the heck has Medifast continued plummeting all the way down to $40 where it currently sits? They had earnings just a few days ago, and the headlines didn't seem too bad. They beat on revenue, they beat on EPS, but what that means for the future of the company is where things look a little rough. To start, fair value does look very high, 145 for a stock that's trading at 40, but pretty recently, the stock was in the hundreds. Back in 2 years ago, in 2022, it was at $106 a share. In 2021, it was 184, 170 back in 2020. So why is it down to $40? And that would be the recent declines led mostly by the revenues. I mean, we can look at the financials here and see revenues and cost of goods. Revenues climbed from 2020 to 2022, just like the share price. It peaked in 2022 and it's been on the decline since. Now, analysts are expected to bottom out this year and start bouncing back next year. We'll see how accurate they are in that prediction. But one good thing is cost of goods are rising and falling with those revenues. They're not just staying consistent and ending up with a huge loss. Earnings per share are also all over the place. I mean, this 2023 value, $9, it's higher than the $8.74 that they had back in 2020. I mean, they do have less shares now, though, which is part of what's skewing that number. But analysts are only expecting $1.90 this year and $3.13 in 2025. And so that's where a huge amount of value is coming from. Earnings yield looks a little low. Cash flow yield looks very good. They're a very strong cash flow stock. Discounted cash flows is saying it should be in the 300s. And so that's why it's really on my radar. They suspended their dividend because operational challenges. I mean, a decline of 30% in their revenues when they're paying out half of their earnings as a dividend, it's just not worth it. So they need to focus on the company, and cutting that dividend was a good idea there. These returns are insane. 49 ROE, 39 ROI, 32 ROA, and the balance sheet's not in a bad place. 0.5 debt to equity ratio. Margins are really good, 72. This last year, 73 on average, and net right around 10%. So they do have quite a bit of expenses to be having gross margins in the 70s and net barely double digits. There's a lot of expense there. Revenue growth, we looked at the chart. I mean, if we can break it out and just assume 20% drops on average over the next 3 to 5 years, we can take a look at what that will give us. Share count, they are consistently buying back those shares around 2%, so we'll stick with that. Cash flows, I don't know if the revenues are going down. Somehow they're managing to keep their cash flows pretty level. Managing to keep their cash flows pretty level aside from 2021. A little bit of growth over this time frame, but we're just going to assume that they keep it flat. Assets, they did lose a bit in assets this year. Nothing too crazy. They had been growing it, so we're going to go pretty close to zero, almost a midpoint between these two. The liabilities, they have been very good at decreasing those liabilities. If we take a look at this balance sheet page, we see assets have kind of leveled off a little bit, slight growth. Liabilities, though, are in a pretty good decline. And dividend, we already said they suspended it. Margins, they're a little lower than usual, so nothing too crazy here. And that would fetch you negative 8% returns year over year. So I know it says if you buy right now 40%, you'd be looking at 130% returns over the next 3 years. But if they continue with these declines and the share price is already this low, you wouldn't really expect it to climb back up to the fair value. It probably would stay pretty flat or continue to drop because people are buying in hopes of future value. So once you see this thing start to turn around, I mean, ideally, the fair value would start to rise and the share price would as well. And at some point in time, the two would coincide and you'd be sitting on good returns there. It's a pretty obvious turnaround play, even if they can just keep their revenues right where they're at with the share buybacks that they've done, the shuffling of the balance sheets, 3% returns, nothing crazy, but it would help turn around the share price drop and would fetch multiples. This could be a double, triple bagger if they're able to start turning stuff around, even if they can only pull in single digit annual growth of 5%, since that seems to be what they've averaged over the last 3 years. Factoring in the drop that they experienced, you'd be looking at 6% returns. Not too bad. Cash flows, if they're coming in with higher revenues, it should affect their cash flows, help bring those up. So even if we bring those up 2, revenues up 6, now we're looking at 7% returns. Essentially in line with the markets. They reinstate a dividend, start growing it again. All of a sudden, you're looking at potential growth in line with the markets, starting at a very underpriced value where you could get a triple bagger over the course of the next 5 years. So it's definitely something that I'm interested in. I think that they're pretty heavily reliant on Asia and China specifically. They do have some offices, Optiva, in Hong Kong, and it looks like a few different subsidiaries in Asia. But here's what we're looking at for everything graphed out. I mean, the share price drop isn't 100% unwarranted. You can see that there's huge drops in the dividend. Of course, that was a huge blow to them. The fair value is dropping because the earnings are dropping. Balance sheet holding pretty steady, slowly climbing. Cash flows are what are going very high. And cash flows at the end of the day are one of the most important things for a company. So I'm definitely very interested in this, especially at the price that it currently sits. I mean, it's been as high as 114.5 in the last 52 weeks, and it's sitting at $40. So triple bagger would bring you up to just about where it was sitting a year ago. If they can start to turn things around, even get back in line to what we had seen last year and the year before that. So watch list now might be a good time to start a small position. Nothing too crazy because it is a pretty risky turnaround, and we'll keep an eye on this one to see what happens with it. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.